Welcome to part 7 of our chapter 6 discussion. So now that we've concluded our discussion of absorption versus variable costing, we're going to look at decentralization and segment reporting. So a segment is any part or activity of an organization about which a manager seeks cost, revenue, or profit data. So this could be an individual store, for example, a service center, or even a sales territory. For example, if we're looking at the Western United States versus the Southern United States versus the Eastern United States. So it just depends on the company how they break up their segments. But a segment is any part or activity of a business where a manager is going to want cost, revenue, or profit data about that area. So a manager might want to know what something's costing or what revenue something is bringing in or just overall profit data, because not all segments are revenue generators. Some of them only cost something to operate, like our service departments, like a service center like we looked at with the service department cost allocation. So just if we're trying to figure out how would I know if something's a segment or not, it's just any part of a business that a manager would want information about, specifically cost information, revenue or sales information, and or profit information. So with business segments, if we want, for example, profit data about the different sales territories, then we can set up income statements for each of those segments separately. But a contribution format income statement for purposes of internal reporting, if we're just looking inside, a contribution format income statement is going to be the best, because we've talked about it before that the contribution format income statement, it enables CVP analysis. So segmented income statements, however, they are required for external reporting, but when you set up those segmented income statements for external reporting, they have to be set up using absorption costing. But for internal purposes, it's really helpful if managers take that extra step to do a segmented income statement in the contribution format so that they can look at each segment's different variable and fixed cost components and its sales components to make certain analyses regarding its costs, revenues, and profits. So again, we would want to use that format because it splits those costs up between the variable and fixed elements. And also, by using that income statement format, we're able to find the contribution margin of every segment on its own. And each segment will have its own traceable fixed costs as well. So with a segmented income statement, you want to separate the fixed costs that are traceable to each segment from the common fixed costs that are incurred for the entire organization. So in a segmented income statement, which we'll be looking at a little bit later, you list each segment's sales, each segment's variable costs, and then you find each segment's contribution margin, and then you first list each segment's separate traceable fixed costs, the fixed costs that are attributable just to that segment. And then you are able to find the segment margin, and then from the segment margin we subtract out the common fixed expenses that aren't traceable to any given segment to find our overall net operating income for the company. Now, what is a traceable versus common fixed cost? Well, a traceable fixed costs, this exists because the segment exists. So if we were to get rid of a specific product line, it's possible that that product line's manager, that manager's salary, would disappear along with the segment disappearing. So traceable fixed costs, they exist because the segment exists, and they would go away if the segment were to go away. But a common fixed cost, on the other hand, these are fixed costs that exist because the company is in existence, and they wouldn't necessarily go away if we get rid of one segment of the entire business. So for example, if I get rid of a specific product line, any salaries associated with that product line might disappear along with that product line going away. But for example, the CEO salary of the entire company, that salary wouldn't disappear along with just one product line or that one segment being discontinued. So difference between traceable and common fixed costs. So the traceable costs we assign to the segments that they are coming from, but the common fixed costs, they get listed separately and they don't become a burden of any of the segments because the segment shouldn't bear the burden of a cost that isn't traceable to it. So common fixed costs are listed separately. And then we briefly mentioned segment margin. And again, segment margin, it's simply what we find when we take the traceable fixed costs for a segment and subtract it from that segment's contribution margin. So it's basically you find your sales of a segment minus the segment's variable costs. That gives you the segment's contribution margin. And then when you subtract out that segment's fixed costs, its traceable fixed costs, then you're left with the segment's margin. That tells you how profitable that segment is on its own. And that's the best gauge of how profitable that segment might be looking into the future. And then you add up all the segment margins to find the total segment margin as a company as a whole, and then you subtract out any common fixed expenses to find the net operating income for the entire organization.